Chapter 14, Leverage Ratios. In this chapter, we will calculate what are known as leverage ratios. They help us determine the debt-paying ability of the company. Can it borrow more? Also, does it earn enough to pay interest expense on its existing debt? Leverage ratios determine what we call the capital structure of the business. They answer the question, would the business qualify for a loan? If so, how much? Does it have sufficient profits to pay its interest charges on existing debt? Here we introduce three key ratios. 1, total liabilities divided by total assets. 2, total liabilities divided by stockholders' equity. 3, operating profit divided by EBIT, earnings before interest and taxes. First, we look at how much of the company's assets are financed by debt. That's total liabilities divided by total assets. Liabilities, $325,000. Total assets, $650,000. That gives us a ratio of 1 to 2. The standard is 0.7 to 1. That means the amount of debt used to finance assets is within guidelines. The company can borrow more. Next, we divide total company liabilities by equity. Total liabilities, $325,000. Equity, $275,000. The result is 1.18 to 1. That means the company has $1.18 of debt for every dollar of equity. Now consider this. If you buy a home with a 20% down payment, your debt to equity ratio is 4 to 1. You're borrowing $4 in debt for every dollar of equity. The loan covers 80% of the purchase price, but an operating business cannot borrow at a 4 to 1 ratio. There's more risk in running a business than owning a home. Our current ratio of 1.18 to 1 suggests that there is room to borrow, possibly up to $2 of debt for every dollar of equity. Here we have total liabilities of $325,000. Here we have common stock, $50,000, additional paid-in capital, $50,000, total contributed capital, $100,000, beginning retained earnings, $155,000, plus current earnings, $35,000, minus dividends, $15,000. That gives us total retained earnings of $175,000. Total stockholders' equity, $275,000. And yes, liabilities and equity equal $650,000, which matches total assets. Now, consider applying for a mortgage on a home. The lender typically wants a 20% down payment. The lender also wants proof that your income is equal to 4 times the annual debt service. That's principal and interest. Why? Because they know you have many other living expenses: food, clothing, car payments, insurance, taxes, medical costs, and more. So the lender does not want the mortgage to exceed 25% of your total earnings. In a business, it's a little different. The lender wants to see income of at least 5 times the interest charges. We call this the times interest earned ratio. It's calculated as income before interest and taxes, or EBIT, divided by interest expense. Here we have EBIT, earnings before interest and taxes, of $56,000, divided by interest expense, $11,000. That gives us a ratio of just over 5 to 1. The ratio is adequate, but more borrowing would mean more interest expense. Unless income increases, we would not have the earning strength to support additional debt. In this series on ratios, we'll identify opportunities to improve the company's earnings. In this slide, we have removed depreciation expense to calculate a subtotal called EBITDA. That's earnings before interest, taxes, depreciation, and amortization. EBITDA is $62,000. Deduct depreciation of $16,000, and we arrive at EBIT, $55,000, divided by interest expense, $11,000. The result, 5 to 1. We meet the standard. But as mentioned in the previous slide, more borrowing would require improved earnings.